davet ediyorum.
Herkese merhabalar. Hayırlı cumalar diliyorum. Cumanız mübarek olsun. Bu bölüm İngilizce olacak. Konuşmaya İngilizce devam edeceğim. 3 konuşmacımız var gördüğünüz üzere. Yaklaşık 20'şer dakika hepsi sunum yapacak. En sonunda da soruları alacağız. Honorable speakers, distinguished guests, ladies and gentlemen, welcome to session 2. Interest-free finance regulations around the world. My name is Fatih Kazan, working at World Bank Global Islamic Finance Development Center, and I'll be serving as your moderator for this session. In this session, we will take a look at the other country experiences on establishing and developing their regulatory framework. Turkey's participation finance, we discussed it in the morning session and afternoon session as well, is still less developed when compared to countries such as Bahrain, Malaysia, and Saudi Arabia. Absence of a well-developed regulatory framework is one of the main challenges faced by the participation industry. However, there is a strong commitment from the policymakers and all stakeholders to further development of the industry. The establishment of high-level interest-free coordination board is a step in the right direction, and I believe the enactment of this comprehensive law, draft law, will create a great momentum in order to achieve a higher share in the market. We have 3 eminent speakers to share other country experiences on Islamic finance. As I said, each speakers will have 20 or 25 minutes, and at the end we are going to have a Q&A session. I would like to welcome to our first speaker, Prezana Sesechalam. I'm sorry if I pronounce your last name. To deliver his speech on different country experiences, considering the differences in principles, components, and models in Islamic finance regulatory framework. Prezana is the founder and CEO of Tejas Consulting Company, providing solutions in various aspects of governance, risk management, and compliance. He provides consulting and professional advisory services to financial regulators and currently working as a World Bank advisor. Prezana has over 25 years of experience in the financial services sector, including over 14 years of regulatory experience. He has a strong base of knowledge, expertise, and experience in the financial services regulation, having served in Canadian financial regulator, OSFI, and as a member of the senior management of Dubai Financial Services Authority. All right, Prezana, the floor is yours, please.
Thanks, Fatih, for your kind words. First, let me just start off by thanking the organizers and the World Bank Group for giving me this opportunity to come here and speak to you and share with you what I know about regulation of Islamic finance and what I've seen and learned over the last few years, actually. It's been great, coming again to Istanbul, and it's so nice to be. I don't think I've ever spoken in a hall which is as ornate as this, actually. So it's really nice to be here. Considering, I don't know whether everyone can hear me. Can you hear me? Okay. Now? What about now? Okay. Yeah, I think I have to speak up more. Yeah, I'll just, considering that we are, I would like to make my presentation a bit faster so that we can have more time for discussions, and probably we are running a bit late as well. Yeah, I'll just, I will start off giving a brief overview of the concept of financial regulation, and then move on to what is Islamic banking or Islamic finance or participation financing, and how does it differ in terms of risks involved from conventional financing industry, and then move on to what are the key factors which go into the design of a regulatory framework for participation financing, and how we would like to consider each one of those factors and talk about it. And then quickly talk about a couple of key issues which have kind of been proven to be a thorn or kind of a irritating factor for many of the countries while dealing with them. For example, the sukuks, regulation of sukuks, definition, how they have come to accept it in the markets, or the role of PSIAs for Islamic banks, participation banks, and how they have how they've been operated by participation banks, how they've been accepted, and what kind of regulation has worked, and things like that. So let me quickly start off. I mean, very basically, why do we have financial regulation? Probably this is something which you would have heard about it. Basically, the regulators want to achieve their financial institutions operate in a safe and sound manner. They want to take care of consumers, protect the client money and assets, particularly when those client money and assets are not in the form of deposits, which are under guarantee. They want to make sure that the financial institutions operate in a fair and ethical manner, basically ensure that the business conduct is appropriate, take care of consumer protection issues, and also achieve market integrity and credibility, particularly when you come into question of capital markets, actually. And when we talk about Sharia-compliant financial services, then the additional objectives are one of ensuring Sharia compliance and Sharia governance, actually. And then we had the big event which had a great impact on financial regulation as well, which is the great global financial crisis, which I refer to as GFC. The post-GFC, there have been a few things which have been added on to the basket of objectives for financial regulators. One is this focus on systemic risk. So the regulators started focusing on what is called as macroprudential supervision, as apart from what they were doing earlier, which is microprudential, which is institution-specific. So looking at the financial system as a whole, and considering what kind of systemic risks can come out of the operation of individual financial institutions, became one of the key objectives of financial regulation, which is financial stability, dealing with systemic stability, contagion risk, and things like that. In the case of Islamic banks, or participation banks as it's referred to here, pardon me, I'll just keep on using those terms interchangeably because of my I'm so familiar with using Islamic banks. There's a consequence of, there are two main issues which I would like to highlight, which is, one is the consequences of the participation banks or Islamic banks failing or disappointing the customers in terms of Sharia compliance, because that's one of the key issues why the customers are coming to the industry, or at least a very high share of the customers would come to the banks, and there is a very important focus which has to be laid on that. And also when it comes to participation banks and the adverse impact of such a disappointment faced by the customers, and what they will do in terms of how they will deal with in terms of the relationship with the customer, with the bank, and would they disrupt, will they just redeem or things like that, and how do you deal with those risks? So the consequences again of systemic Sharia non-compliance, which is something like what happened in Islamic in sukuk market. Suddenly a concept of sukuk, or how a particular form of sukuk is declared as, okay, this is not Sharia anymore, which is more systemic, which can have a very destabilizing impact on a segment or a product category or a sector of the market. And also in some cases it could be just institution specific, where an Islamic bank is seen as not being Sharia compliant. Again, if you look at the principles, broad principles of financial regulation, which are consistent with the objectives I've laid out, basically the regulation has to be broadly structured and delivered and implemented in such a way that the FIs are managed in a safe and sound manner. Their business conduct is on the lines of fair and ethical dealing towards the customers, other stakeholders in the market, other market participants, ensure that the market integrity is achieved when it comes to capital markets and other segments. And one of the key things is that you regulators have to make sure that they avoid undue regulatory burden on the financial institutions. It's not that you can just impose regulatory burden to the extent it achieves regulatory objectives, because there is a point at which it also starts, having a cost or a burden on the financial institutions, which has to be substantiated or justified by the benefits achieved. So that's one of the key principles, and there has to be a reasonable level of deterrence in terms of enforcement, actually. For Islamic banks, again, as the objectives we highlighted, one of the key things is that the regulation should ensure very robust Sharia governance, so that there is you tend to preclude the occurrence of any disappointment among customers in terms of Sharia non-compliance. That's one of the principles. So if you just look at key differences between conventional banks or conventional financial institutions and participation financial institutions. Pretty much participation banks and financial institutions carry are exposed to all the risks which the conventional banks face, pretty much. There will be slight changes here and there. But in addition, there are unique risks faced by Islamic banks or participation banks, which is, first is, they face a lot more of equity risk. There is definitely Sharia non-compliance risk, which I've already highlighted. And then you have this concept of DCR, which is displaced commercial risk, particularly when it is a institution is a participation bank which is offering profit or loss sharing investment accounts, what is called as PSIAs, which in most jurisdictions also involve the concept of profit smoothing to make it work. So when the PSAs come along with profit smoothing, and there is always this displaced commercial risk, which is the concept of risk of profits being moved to subsequent periods to compensate for potential lower returns in subsequent periods. So what if that the investment account or the pool of investment accounts doesn't generate adequate returns to compensate the investors? So we'll talk about it a little more in detail, because that's one of the key issues I want to touch. And some of the risks are elevated for Islamic banks. For example, operational risk, liquidity risk, and legal risk. Operational risk is elevated simply because of, again, Sharia non-compliance risk is part of operational risk. And the mode of operations and the procedures for an Islamic bank involve a lot more moving parts. The nature of the contracts involved are much more complicated when compared to a conventional commercial bank. So the operational risk automatically increases. It's just like having a more complicated machinery as compared to a very simple machinery. And the Sharia non-compliance risk also involves a higher level of legal risk. Apart from this, the other main risks which I've already highlighted is the potential issues which can come out of PSIAs, which is one to do with the potential disappointment of them not getting the returns which they were expecting to get, or which they expect to get because the conventional banks which are operating in a dual system are offering a certain benchmark rate of return, both of which can create a certain level of disappointment. And then you have this concept of inconsistent Sharia interpretation or a lack of market-wide norms, particularly in countries where you don't have a national-wide or nationwide Sharia supervisory board or Sharia standards, and then wherein the individual institutions are having their own Sharia boards. There have been occurrences where there have been inconsistency in Sharia interpretation, and individual institutions are adopting different standards, which have later on turned out to cause a lot of market disturbances, either in terms of the customers not being happy or product categories not actually growing as much as their potential is. So if you look at considering all these things, if you look at, okay, what should be the approach we should take for regulating Islamic banks or participation financial institutions? One is that a very simple thing, a clear and definitive regulatory framework. We should have very clear laws, rules, and regulations, which is internally consistent and based on clearly defined, well-published, well-accepted regulatory objectives and public policy underlying that. And then you have standardized Sharia norms for products and business practices, which can be consistently applied across the jurisdiction or the market. Then it is just about the regulatory aspects, and then moving on to the supervisory aspects, you need the risk-based approach, which has been accepted across the financial regulatory sphere as one of the most effective and efficient ways of administering or implementing supervision. And then you have the systems, Sharia regulation. So there is a choice between Sharia regulation or Sharia systems regulation. So the approach of deciding as to how you approach this regulating Sharia bit, which is, you can have we'll talk about it a little bit more in detail. So you can have a Sharia systems regulation rather than regulating Sharia itself, which can be there, but not necessarily with the financial regulatory, not necessarily as part of financial regulation framework, but it could be separate actually. And the other two key things are flexibility in terms of ability to hire, in terms of being able to hire independent experts, particularly for focusing on Sharia governance aspects, particularly for external reviews of Sharia. Or this is very useful, particularly for emerging markets where the industry is growing, because their institutions are likely to be smaller, and if they don't have this flexibility, the cost level immediately increases because of the fact that they may be forced to have internal Sharia departments, which is much more expensive to have, and which will consequently impose obligations on them to have a much higher size. You're effectively making precluding smaller or growing Islamic financial institutions if you don't have this flexibility. And windows. It's a very unique concept, you can say, or in some cases you can say it's a very difficult concept as well. But again, if you're looking at jurisdictions or markets where participation financing is coming up, so this could be one of the ways in which it could allow the growth of the industry, growth of the practice. So let's move on to what are the key considerations for design of a regulatory framework for participation financing. One is, do you want to have an independent regime for Islamic banking, or integrated regime in which it is dealt with under the same framework as for conventional banking or conventional financing? Second, regulating Sharia systems and governance, or regulating Sharia itself. Again, we talked about it. Allow Islamic windows for conventional banks to offer participation financing products and services. Do you want a dedicated prudential regime, or just an additional layer on top of an existing prudential regime, which is like Basel III capital liquidity rules for conventional financing and conventional banks? You take it and then apply a layer of prudential rules which use the existing layer for Islamic banks. So that can be an approach. And how to achieve market-wide consistency in Sharia interpretation and standards, National Sharia Supervisory Board, or and the flexibility to acquire external expertise. I kind of talked about it. Let's go on to see how this is happening across many countries. If you look at the regulatory framework, you see that in most of the countries they have a dual system with a separate law for Islamic finance. But again, many countries have an Islamic finance law, but the extent to which it offers a separate regulatory system, or how it is being used, implemented, varies. So you can have a country like Malaysia, where there is a separate Islamic finance law, which talks about various aspects, various sectors of Islamic finance, and also offers an exclusive separate regime for dealing with participation financing. Whereas at the same time, you can also have a country like UAE, which has a separate law for Islamic banks, but the law doesn't say much, actually. In practice, in UAE, financial services is regulated in the same way, both for conventional and for Islamic finance. So literally, if you look at regulations for banking or insurance, there is insurance, it's okay, it's slightly improving. For banking, there's pretty much the same rules, regulations, even though there is, in paper, there is a law in UAE which says there is a law for Islamic banking. So the extent of implementation is different, but you can say most of them have different dual system. Even except for countries like UK and Canada, which are, for lack of a better word, you can refer to them as secular countries just for common purposes. So you have countries, like jurisdictions like DIFC, particularly where it is a dual system. There is a Islamic finance law separate, but again, as I said, the rules and regulations are not dedicated. They pretty much use the same framework of rules and regulations, and wherever required, they just add a layer of rules to address specific aspects of Islamic banking or takaful or Islamic capital markets or whatever. So it's not a dual system in that sense that there is a dedicated, full, comprehensive framework only for participation financing. To this, here I'm giving a little bit more detail about regulatory regime, what I talked about just now. You can see that the different countries have different levels of, separation, and the extent of having dedicated regulatory regime is different across the regimes. And you have a single rule book as well in some countries, like apart from the secular countries like UAE, and some other countries also use the single rule book. So the other big question is Sharia systems regulator or Sharia regulator. I'm come from a school of thought which is very comfortable and very conversant with the Sharia systems regulation. So as I said, I'm talking about financial services regulations. I'm talking about a financial services regulatory authority or a regulatory framework. So you can always have a Sharia regulation separately, but when it comes to financial services regulator, and consistent with the objectives and the way of operation of financial services regulator, which is focused on risk, and then wherein all the processes are tuned and with the emphasis on risk, measuring the risk and applying rules, and then enforcing the rules. It is better to look at systems regulation, where you're talking about a certain Sharia governance framework, responsibilities, accountabilities, and how Sharia needs to be properly ensured that the practices, the operations, procedures of the participation bank are compliant with the Sharia principles. Rather than going into the Sharia regulation itself. When I say Sharia regulation, then it would be a situation where the authority actually specifies what is Sharia compliant. I think that should rather be kept separate. Either it is the one way of doing it is to give the give that responsibility to Sharia Supervisory Board of institutions, or to have a national level Sharia Supervisory Board, which is independent of the financial services regulator, which has the authority and responsibility to make decisions on that basis. So for us, for the financial service regulator, it's all about having a framework of Sharia governance, where there will be a need for a Sharia Supervisory Board, and what kind of responsibilities they have, what kind of authority they have, and need for internal Sharia review procedures, and how conflicts are addressed and things like that. If you look at that in terms of Sharia Supervisory Board, many of the countries have national institution-specific Sharia Supervisory Boards, and which are basically one way of implementing Sharia systems regulation. And there is Malaysia, which has a National Sharia Advisory Council for validating Sharia compliance of all the products and processes, but they also have a requirement for institution-specific Sharia advisory committees. I think I'll just quickly go across, considering the time involved, in terms of moving into prudential regulation, which is a very significant aspect of particularly regulation concerned with participation banks. The aim is to achieve safety and soundness. It's always based, it's primarily based on risks. It's a proactive approach that basically measure the risks faced and then come up with the supervision measures. The rules like Basel III, whatever, which is the most simple, most common symbol of prudential regulation, is a clear illustration of this risk-based approach to supervision regulation. There are two main components. One is focused on capital and the other one on liquidity. When you come to the Islamic banking world, IFSB 15 is a global standard which implements the Basel III framework. And when you look at it, apart from the capital and liquidity components of Basel III, IFSB 15 also deals with the risks which we earlier talked about, how to deal with Sharia non-compliance risk, and there are unique risks like rate of return risk and displaced commercial risk. We talked about it. And the aggravated operational risk profile. If you look at most of the jurisdictions where there is Islamic banking is prevalent, almost all the countries have implemented IFSB standards, with, of course, with different levels of progress in terms of implementing the latest version. Like if you look at IFSB 15, some of them have implemented, but some of them are in the process of implementing them. And this will bring us to one of the key issues we are talking about, which is the PSIAs. Because displaced commercial risk is a concept which is brought forward by the IFSB standard, actually, not by Basel III. The other thing which I want to talk about was core principles for Islamic finance regulation. This is modeled and developed on the lines of Basel core principles for banking supervision. There are similar core principles for regulation and supervision of insurance, capital markets globally for conventional financial services. So IFSB is now going through the process of having core principles for regulation of banking, insurance and capital markets, of which banking segment, the core principles for Islamic finance regulation in the banking segment is already out, IFSB 17, I think. Why I'm referring to this at this point is that this can easily be seen as a very convenient benchmark, paradigm, or standard for anyone who is looking forward to set up a regulatory regime, or someone who is trying to assess their own regulatory regime to see how well it is operating, how well it has been structured, how well it is faring in the context of a global standard. This is almost like a global standard for regulation of Islamic finance. So it specifies a core regulatory standard. It covers all aspects of the Islamic banking business. So if one were to look at a specific regulatory approach or regulatory framework for a country, and this will, core principles will offer a clear system or a framework on which the framework can be measured, can be assessed, whether it's how good it is, how comprehensive it is. And this is something what multilateral institutions will use going forward, like World Bank and IMF, when they come to assess the quality and effectiveness of a regulatory framework of any country, so which is having a significant share of their financial system in participation banking. So that's why I just wanted to touch upon this. This is, I wanted to talk a little bit in detail about these specific issues. One is on the PSIAs and the sukuks. Very quickly, in my view, I think that this is one of the key issues facing Islamic banking industry, wherever it is across the world, in terms of the nature of PSIAs, the role, the risks involved. And then there's always a discussion on asset-based and asset-backed sukuks and implications for credit risk. And then you have a whole series of issues on Islamic capital markets. So talking about shallow markets, low volumes, how it affects a lot of trading happening on OTC markets rather than on listed markets, and what kind of implications it has on market transparency and things like that. There's a lot of questions around that. So let's go into the PSIAs. See, this is in most of the countries where PSIAs are available. This is seen and offered by the industry as equivalent to a deposit so offered by a conventional industry. It's a prime source for fundraising by the Islamic banks. When they compete and coexist with commercial banks, this is the way they tend to fund their balance sheets. So they tend to, from the perspective of depositors or investors, they have been, in my view, they have been given the impression that these are almost like deposits. Okay, there is an implicit expectation cultivated among investors saying that they will get a certain rate of return which is not very different or not much lower than what the conventional banks are offering. Of course, as we all know, conventional banks have they have a much better, easier life, because in terms of offering a deposit, they can specify a rate of return and a particular duration for the deposit. And the operation of conventional banks are structured in such a way that they assume any risk which is involved in paying up for that. Suppose if their assets are don't earn the returns, and they have to actually they make losses basically, because they have to still remunerate the depositors. Whereas in the case of Sharia compliant banks or participation banks, that is not possible, because it will be seen as Sharia non-compliant. So that's how the PSAs came up. So in the PSAs, as I said, is structured in such a way that whenever the PSA asset pool makes lesser returns, then the profits accumulated in the previous years is made use of to address the risk, and then are made use of to increase the returns offered to the investors. But this creates the risk this basically leads to the investors getting the expectation that they will always get some return which is pretty close to what is being offered in the market. As I said, one of the worst things which can offer to any business, any offering a product or service, is customer disillusionment, or what I call as cognitive dissonance. You know, if you raise an expectation, it's even worse. Actually, if you don't raise an expectation, actually you're better off. And so this is the basis of my argument in this case. So particularly when you have unrestricted PSAs, in PSAs you have two types. One is unrestricted, and you have restricted PSAs. These unrestricted PSAs often they raise funds, mingle with the funds, other funds of the participation bank, and then use it to fund the assets and raise returns. So if the returns, if for whatever reason the returns raised are not adequate, then the bank would be forced to dip into the reserves it has created, what is called as profit equalization reserves. But if this underperformance continues for a long period of time, maybe for 2 years, 3 years, if there is a situation in which they don't have enough profit equalization reserve, then what happens? I mean, that's then there would be a situation in which they will be making returns or providing returns to the investors, which is much lower than what is being offered in the market by conventional banks. So there will be a situation of disappointment among investors, particularly when they have already been given an impression that they will somehow be paid on returns comparable to conventional banks. So this is a significant issue, particularly in where the Islamic banking segment is a significant share of the overall banking segment, but it's not very big. Let's say 10 to 20% market share or something like that. So there is always a prospect of investors, moving away from Islamic banks, maybe from one bank to another, or from the entire participation banking sector to conventional banking. So this is one of the biggest. This is one of the biggest risks, and also more critical because this can easily and very quickly, escalate into some kind of a systemic risk problem. So it's not just an issue from the Islamic bank, but also more of an issue for the regulator, because at some point of time, very quickly, this can escalate into a broader distrust or lack of comfort with the Islamic banking segment, which can be more of a source of systemic risk, more of a macroprudential issue than just a microprudential institution-specific issue. So this is something which is which is something which I have been talking about repeatedly. So if you look at how to take care of this, one of the things could be that you define PSAs and then present them clearly, more on the lines of restricted PSAs, which in many countries are just offered as investment accounts. So there is no concept of profit smoothing offered. It's more as offered to investors as a pure risk-sharing product, which is very much consistent with the basic fundamental Sharia principle of risk sharing. So you're basically offering that just like investment in a mutual fund is. So this is what it is. If the performance is good, you will get more. If performance is less, you are likely to get less. There's no concept of profit smoothing. So there's no expectation built up among the investors. So there is less likelihood of them getting disappointed. Obviously, the market will take care of the rest, just like mutual funds in most parts of the world. So institutions which perform well, which manage their PSAs better and give better returns will get more funds, and the institutions which don't provide good returns because they are not able to manage their PSAs well, they won't get funds, so they will eventually move out of the market. So basically it becomes more like a pure risk return offering, rather than trying to match a deposit offering. So that's where my thinking is. And this is not something.
Sorry for interrupting. You have only a few minutes, please, to finish your presentation. Thank you.
Okay, thanks, Fadi. Yeah, basically this is what Malaysia has done, and we have also implemented the same framework in DIFC, actually. And so in terms of I'll try to quickly go through in terms of investment account holders. I mean, if you go down that way and you have restricted PSAs, one of the outcomes of that is that you have to give additional protection to investment account holders and treat them as investors in mutual funds. Basically, there has to be a much higher level of conduct regulation, much higher level of protection offered to them from that aspect, in terms of making sure that the participation financing institutions operate as a mudarrib, basically. So they have a higher level of fiduciary duty and care towards the investors. So that's the conduct supervision element has to be escalated, not just supervision, the conduct regulation. So in terms of disclosure of mandates, policies, and the guidance on fulfilling fiduciary duties, and segregation of money and assets belonging to the PSAs. It should not be commingled, as well as it has to be kept separate, and there has to be specific regulations on how it is protected. So if you look at PSAs across regimes, you have, as you can say, still a lot of countries or jurisdictions are offering unrestricted PSAs with profit smoothing practices. You have places like DIFC where both are offered, and in Malaysia they have pretty much taken out this concept, and so there's no concept of unrestricted PSAs. So one of the other things which I talked about is Islamic windows. Yeah, definitely it's very complicated for regulators and for supervisors to manage this, but at the same time it's a very convenient tool to further and advance Islamic banking or participation financing in a new market where it is a growing concept, because it's very easy for a conventional bank or existing institutions to participate in Sharia compliant or participation financing market through this route, rather than set up branches or rather than set up separate subsidiaries. But it has the supervisory aspects of windows can be very complicated, because as I said, it's very difficult to monitor commingling Sharia compliant funds, how it is used and how it's not used, and things like that. Again, you can see many of the countries, like some countries like Qatar, have gone ahead and completely banned windows, but there are many other jurisdictions where still offer allow windows, actually. I think I had quite a few things to say about Islamic capital markets, but in the interest of time, I think I'll stop with this. Yeah, thank you.
Thank you very much, Farzana, for this informative and interesting presentation. Now we have Dr. Hilmi Nisar. Is that okay? No problem. Okay, now we have Mr. Abdulillah Beratik, His Excellency, Secretary General of the General Council for Islamic Banks and Financial Institutions, SIBAFI. Mr. Belatik will deliver his presentation on regulatory and governance framework for Islamic financial institutions, especially in GCC, Gulf countries context. Mr. Belatik is a cross-cultural finance professional with nearly 20 years of experience, including in leadership positions in major financial centers from Europe, the United States, Asia, and the Middle East. Prior to joining the SIBAFI, he was Assistant Secretary General at the IFSB, where he was the co-head of the Technical and Expertise Development Division. Mr. Belatik has held membership positions in several international board and committees, including the International Assurance and Auditing Standard Board Consultative Advisory Group, the International Accounting Standard Board Advisory Group on Sharia-compliant transactions and instruments, and External Advisory Group of the IMF and the Waqf Fund in Bahrain. Mr. Belatik, Your Excellency, the floor is yours.
Thank you. Thank you so much. Bismillah ar-Rahman ar-Rahim. Distinguished guests, Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh, and good afternoon to everyone. I think we have here a core team of participants that you have been for this whole day until here. You must have really courage. So I will truly try to make it very brief, and things that were covered by my friend Prasanna, will try to skip them. So, and I will not cover all these points for sure. Just very briefly, first, this I must say it, SIBAFI, perhaps those that do not know it, is an international organization which is based in Bahrain. It is affiliated to the Organization of Islamic Cooperation. We are the Global Association of Islamic Banks. We have over 120 members from 32 countries, and we were happy and lucky this year to have participation. Of course, we have participation banks from Turkey that are member, and we have since June this year the chairman of the Association of Participation Bank is also became member of the board of SIBAFI. So we that's one of the reasons why I'm actually also here answering and for this presentation. So, on the approach to regulations as covered by Prasanna, there are, in general, 3 or 4 different ways, from no regulation for Islamic banks at all and like having everything same from conventional banks, to some kind of regulation which is embedded into the conventional banking system, to 2 different systems or regulations, one for conventional and one for Islamic. And to perhaps not to be mistaken, we sometimes, having large market share does not necessarily mean those countries have complete regulation. If we can see here from GCC, and we were asked to do this presentation on GCC, perhaps if we can say globally, we have probably 3 countries that maybe in terms of regulation or infrastructure in general, not only laws and regulation, but infrastructure for Islamic finance, meaning the availability of sukuk, monetary instruments, etc. So it's not only regulation, but a lot of ecosystem that we can say that is needed to support the development of the industry. Globally, we have like Malaysia, Bahrain, we have which are kind of hubs for Islamic finance. We have more local markets, such as Sudan, for instance, which has also very comprehensive sector, but is more local. If we look at this, here we see on GCC how the regulation is. And perhaps if we look at this maybe 5 years ago, we would not have maybe not even less than half of this. So there is a progress in implementation of regulation. Just some examples, and I think perhaps some examples of some countries. In Kuwait, even though they started, of course, from 1975, something like this, with Kuwait Finance House. regulation has been coming gradually, and even though as of now, even though, for example, when we see here on the centralized Sharia committees, it's still not completely a real centralized Sharia committee for the banking sector. Qatar, I think, covered by Prasanna before. Perhaps Bahrain is one of the most advanced regulatory regime and infrastructure for Islamic finance globally, together with Malaysia, and they also always try to go hand by hand with the conventional system. Whenever there is any regulation that applies, for example, Basel III, if they do regulation for the conventional, immediately, almost same time, they do for the Islamic side. So I think one point I will talk about it is this one a little bit more, is on the recent, just in September 2017, the issuance of a new governance, Sharia governance law, which I think will be implemented from next year. And I think it's something, this one perhaps one of the most comprehensive globally and perhaps advanced in many factors. So this one, this new Sharia governance model, it lies on 4 components. The first one is, of course, we have the Sharia board. Then on the second, you have the implementation, meaning the link between the Sharia board and the operations of the institution. On the other hand, you will have the internal audit, which will ensure, or to ensure internally, that the requirements by the Sharia boards have been implemented. And the really new point is on the independent external Sharia compliance audit, which is similar as an external audit by external auditors. And it will be done under ISAE 3000, which is engagement reviews. And I think this is really something very important. So a little bit more details on the governance structure, so giving a little bit more explicit on the roles of the Sharia supervisory boards, on the structure of the coordination and implementation function, this also giving a little bit more details on it. And as I said, really the significant point is the independent external Sharia compliance audit function. So globally, moving forward, what we have seen, for example, for the last 10 years going to now, if we consider, there are, I think, perhaps 2 key points that can be considered. If we consider national Sharia boards or committees, if we look back maybe 10 years ago, maybe there were 2 or 3 countries that had it, like Sudan and Malaysia, Bahrain at the level of the central bank. We see this more and more happening now. In many countries start doing it, even in Africa, Nigeria and others, Morocco. We talk about, Tunisia and other countries. The recently issued exposure draft also by IOFI on external Sharia audit. This has been something requested by many professionals for the last few years, and it is happening. And then again, having, as we said, Bahrain and Kuwait that started the implementation of this external Sharia audit, which I think will play some roles in, perhaps together with centralized Sharia boards, in more harmonization of the industry and providing more transparency to the operations of the Islamic banks. So we'll have the opportunity to have questions in case you have later on. Thank you.
Thank you very much, Mr. Belatik, Your Excellency, for your valuable presentation. Now we have our last speakers, Dr. Hilmi Nisar from Islamic Research and Training Institute, IRTI, from IDB, to deliver his speech on Indonesian experience and Malaysian experience. And I believe he's going to share with us some other different country case studies as well. Mr. Isar, the floor is yours. Thank you.
Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullahi wa barakatuh. My apology for the voice. I think that's the advantage of being the last speaker. I just need to pronounce Sadaqallah al-Azim, because much has been said. So that's the advantage. And obviously everybody is looking forward to having a very vibrant and fabulous supper in a Turkish way. Right. I will talk about 4 main things. I don't want to make it sound very complicated or The first is on some of the issues, typical issues when we start about how to go about implementing or establishing an Islamic finance industry in certain country. Second, on some of the regulatory reforms, and perhaps on this aspect I may not necessarily, on purpose deliberate further, because I think the presentation by our colleagues and friends, Brother Abdullah as well as Prasanna, have been somewhat very rich. And later on we will talk about some of the key milestones of the Islamic banking and finance in Indonesia, and you will be seeing later on that the Indonesian government as well as the Indonesian sort of Islamic finance community or society, they have the aspirations of moving beyond banking. So if some of the jurisdictions, they are still very much into how to develop Islamic banking, we try to go beyond banking. We will see later on how it goes. And the last one would be the way forward. The typical question or the typical issue that is encountered by any jurisdiction when we start the Islamic, they have the intention to start Islamic finance or even an Islamic bank, is how to go about, where to start and how. Rather than talking about this thing in a very theoretical, sophisticated manner with running the regulation model and so on and so forth, let me share with you some of my experiences engaging with some of the jurisdictions. First is in Tanzania. In Tanzania, what happened was when they wanted to establish an Islamic bank, there wasn't any sort of legislation, official legislations or law to become the umbrella of functioning the Islamic bank. So what they did was, in cooperation with the IDB group as well as the World Bank, the first thing that they did was to change the definition of the deposit. Right? And that is somewhat, although it's not going to be exactly the same as the case of Suriname, Suriname is very interesting, because when we had our engagement with the Suriname key stakeholders, they do not have the umbrella, but from the definition of a firm offering financial services, it appears that offering Islamic financial products may still be possible. So the key message over here is that, sometimes we cannot really generalize how to start and where to go. And in the case of Indonesia, for instance, they, rather than creating an umbrella as the legislations or to start Islamic bank, they start from the product. So you can see the different models of Islamic banking development in Indonesia. Say for instance, as compared to Malaysia, Malaysia is obviously very comprehensive from the Islamic capital market, Islamic banking, takaful and retakaful, as well as very tiny or little on the non-social, or we call it now social finance. And in the case of United Kingdom, I found it very smart, because you will not come across a word Islamic in their legislation. How they do the Islamic bank, or how to make the Islamic bank functional, apparently what they do, one of the strategies is to look at the end economic benefit of the financial products. Right? Let's take the example of Murabaha. Murabaha, you can see there is a counterparty financial obligations against the the product, and the definition of Murabaha. And the smart, I think, very thoughtful act in the Banking Act in the United Kingdom, they even mention the word purchase and resale. So that has been able, this component of the Act has been basically able to enable the functioning of Islamic bank in United Kingdom. However, based on the legislations, there was one major problems that they encounter. As you know, the first Islamic bank in the United Kingdom was the Islamic Bank of Britain. So when the Islamic Bank of Britain started their operation, the first question from the regulator is that, are you going to guarantee the deposit? The Islamic bankers in the Islamic Bank of Britain, they said, now the name is Arayan Bank, they said no. Because if we wanted to implement mudaraba, whether this is mudaraba mutalaqa or muqayyada, as Prasanna said, restricted or unrestricted, then we cannot really guarantee the deposit. So as a compromise step, in the beginning, by law, they still had to guarantee, and the rest was the history, even to the extent that they still have to mention or state explicitly the interest, so-called the interest rate. In fact, within the Islamic Bank of Britain at the time, it was clearly stated just to give the indication, not necessarily guaranteed return or guaranteed yield to the depositor. So moving on, in Philippines, I forgot, I noted during the previous presentations, in Philippines there has been a recent request to bolster the development of Islamic banking as well as the issuance of sovereign sukuk. Many may be aware, or most of us may not be aware, the existence of the first ever Islamic bank in Philippines. It was located in Mindanao. In fact, apparently it was founded 1 or 2 years earlier than Islamic Development Bank Group. But due to some of the political and sensitivity issues taking place in the region, so it has not really progressed intensively. Now, some of the key milestones in Indonesia, as you can see here, the components of the, using the words of Mr. Abdulillah, is the ecosystems in the Islamic financial, ecosystem in Islamic bank in Indonesia. We have Islamic banking, takaful, Islamic multi-finance, Islamic capital market, Islamic guarantee, Islamic venture capital, and the last one is Islamic pawn shop company. The interesting part over the years with the development of Islamic finance in Indonesia is that they have initially created a blueprint for the Islamic banking development. So what they do is they try to envisage how they are going to reach and how they are going to shape the Islamic finance. And the recent progress in the country is that there is also a blueprint for the Islamic capital market, and the last one is the blueprint for the non-bank financial institutions. That includes microfinance and even the, the zakat and awqaf and so on and so forth. One might be wondering why zakat and waqf are included in the financial system. So some of the proponents of Islamic finance in the country, they argue that this is going to be part of the so-called safety net to, to support the development of Islamic banking. So typically they have conventional banks that has the, the window. We call it Islamic commercial banks. We have also Islamic banking units and Islamic rural banks, or dealing with the micro finance. With regard to the adoption of the international standards, such as many publications by IFSP and AOIP, although we are not entirely accommodating those things, we do some modifications, with some of the standards. So we have National Sharia Board as well. One of the differences between National Sharia Board, if I may compare between Indonesia and Malaysia, in Malaysia, the Sharia Board is hosted by Bank Negara Malaysia. In Indonesia, it's not. It's entirely independent. So it's not under Central Bank of Indonesia, nor under the Financial Services Authority. And any proposal to issue the products, it has to go through various steps, and we have the National Coordination Committee in which the members are from different key stakeholders. There is somebody from Ministry of Finance, from Central Bank, so we sit together and getting some feedbacks from different, different stakeholders to understand, because obviously, sometimes we understand regulators, they have different view as compared to the players. So the master plan, this is also one of the recent developments in Islamic banking in Indonesia. Let me carry on here. The pillars of the master plan, first is on the Islamic financial deepening initiatives. Second is government budget development. And the third is to support the infrastructure development. This is the cover page of the Sharia non-bank financial institution roadmap. This is the roadmap for the Islamic capital market. And this is what I mentioned earlier, branding beyond banking. This is interesting. What ought to be considered to establish or to start Islamic bank? First is we have to understand the fundamental. Sharia as the backbone of Islamic banking and finance. Specific approach must be taken to ensure adherence to Sharia principles. Now, we cannot deny the fact that still the implementation of Islamic finance is still very much, although there is a great drill of the harmonization in terms of Sharia interpretation, but which school of thought? And after all, does it really matter? And by the way, I took this photo myself. You will find this thing in Chara if you go to Chara, because you are Turkish, obviously. You go to Chara, and this is from one of the instant noodles. I forgot the brand of the instant noodles. It's very interesting, and this is the only halal stamp in the world. I have done my survey myself. If you go around the world, obviously we are concerned with our halal thing. I asked Professor Mehmet as well as Dr. Najmettin, although I don't understand the Turkish language, but I was intrigued by the back and forth conversations in the previous session, because the gentleman sitting in the corner, as if he was very adamant asking about certain things. So what's happening? So apparently he was suggesting renaming the Islamic finance, and I asked Professor Mehmet, or what, sugar-free or something, or interest-free, because you mentioned faizsiz. So coming back to this is halal banking or halal things, but again, which school of thought? Hanafi, Shafi'i, Maliki, or Hanbali? I didn't want to mention Ja'fari because it will be very controversial. So the following is to appreciate the uniqueness, the uniqueness. Whether you wanted to call participation bank or Islamic fund, to me personally, is entirely up to you, as long as the essence is there. Because it is inevitable. Like look at the Islamic bank in Morocco. They don't call it Islamic bank, am I right? They call it participation bank. The same like in, I think Brother Abdillah from Morocco, right? Yes. You can cross-check with him. In Indonesia and Malaysia, you wouldn't find people saying Islamic bank. We call it Bank Syariah. Bank Syariah or Syariah banking. But when we look at the product, basically mudharabah is, your mudharabah is the same as my mudharabah, as the same as his mudharabah. All right? So to appreciate the uniqueness customized according to the society in different jurisdictions, I mean, we cannot, we shouldn't really make a big fuss about naming. Recognize the environment and also to acknowledge the challenges. I still recall, I mean, has there been any survey in Turkey, for instance, about the perception of Muslims in Turkey with regard to the interest? Do you think all Muslims in Turkey believe that interest in the bank is riba, hence haram? I don't think so. The same goes with if we do survey in other Muslim countries. In Suriname, what we did was, although the Muslim society constitutes up to 15%, do you think if we establish Islamic bank over there, do you think the market penetration of Islamic finance will be aligned with the 15% of the Muslim society? Not necessarily. Right? So with that, I end my presentation. Thank you.
Thank you very much, Dr. Isar, for your informative and interesting presentation. All right, ladies and gentlemen, now we have 15 or 20 minutes for Q&A session. Please ask questions, and before asking questions, please introduce yourself as well. Any question? Please.
Okay, first of all, I thank all the three speakers for their valuable contribution. And you provided a good guideline, and you depict a good picture for us, I mean, in terms of the regulation over the world. Well, first I would like to ask whether you had the chance to see our bill. I mean, I'm sure it's already been translated into English, but have you seen at least the main, I mean, the essence or our new bill? If so, I would ask you, how would you find it? I would like to hear your evaluation briefly. Okay.
So go ahead, Prasanna. I think Prasanna has some time to check our draft bill because he's currently working as a World Bank advisor on some other projects, similar projects as well. So Prasanna, please continue.
Yeah, I had occasion to look at it and then go through the draft bill. There are one of the things which I find it, as I was talking in my presentation, is the fact that you still the bill allows PSIAs with profit smoothing. That's one thing which is it's a good thing because in the sense that at this stage of growth, it will allow participation banks to grow and bring in the funds, attract. But if I were to be in this place, I would take that as an opportunity to start off with a clean slate and start off with a system which doesn't have that issue to deal with. Actually, I think, in my view, there are more risks involved than what has been appreciated so far with unrestricted PSIAs and profit smoothing and displaced commercial risk, which are all linked to the same concept. So if you have unrestricted PSIAs and profit smoothing, because of which you have displaced commercial risk, and of course and the profit equalization reserve and everything, they're all allowed in the law, which is, I'm not saying it's bad, but if you are at this stage at which you are writing the new framework, you have an opportunity to present a much more clear framework, which will be more consistent, which will be fully consistent with Sharia principles, and which will just preclude all these risks. From my experience, I'm always worried about, not just in Turkey, but in any market where this is allowed, this issue turning into a much wider macroprudential or systemic risk because of the cognitive dissonance or disappointment issue which are raised. Because at the end of the day, Islamic banks or participation banks coexist with the conventional banks, which offer a stated return, and that's always going to be that comparison. So it's better to offer a much clearer option which says, okay, this is what you get, which is a return commensurate with risks and risk sharing, basically, not in any way of a product which tends to mimic a deposit kind of a product and things like that. And the other thing which I noted in the bill is there are some provisions about control aspects which I thought it will be very difficult to supervise or implement. It says that if your participation or interest-free financial institution can be held, owned, or controlled only by interest-free financing institution, or a non-interest-free institution, or like say non-Sharia compliant institution cannot hold a Sharia compliant institution, and the capital which is used to capitalize Sharia compliant institution should be confirmed to be coming from sources which are Sharia compliant. Yeah, I'm not saying anything about the intent behind the bill, but it's I can see that it is very difficult to implement it, in the sense from the perspective of regulator. When you license or approve a interest-free financing institution, it will be very difficult to achieve that, for them to prove that. And also for a market at this stage, when you are trying to get more interested parties to start such institutions, it will be difficult and unnecessary constraint to say that it can only be owned by Sharia compliant institution, which will straight away cut off a lot of potential and interested parties straight away out of the game. And I don't think in other countries, I have not at least come across any other country which has a restriction like that. You typically find in many countries conventional banks which have subsidiaries which are Islamic in nature, which is fairly, to be expected. If I were a banker, that's what I would do, because if there is a significant market opening up and I'm a conventional banker, first thing I'll do is, why don't I set up a conventional Islamic banking subsidiary, And there is always governance mechanisms can be brought in to make that subsidiary independent, to make sure that it operates completely in compliance with Sharia principles right from the top. But this, I didn't understand the intent behind it. I'm not questioning the intent, but I can clearly see as a supervisor, it will be very difficult to supervise. First of all, it's very difficult to license, and it will be difficult to supervise, and also will be an impediment to attracting potential, owners or controllers setting up new Sharia-compliant institutions.
Yeah, thank you. We did not have the opportunity to look into details of the bill at all, but we discussed some points. We had a meeting with the chairman of BDDK, and we talked about some of the items. So I think in general, what we recommend from our point of view is that any regulation should not be like copy-paste from other jurisdictions. If we compare, if you have seen the comparison that we say Malaysia has this advance or Bahrain has this advance, but we need to know that this has taken them maybe 30 years, 35 years to be here, to be there. So any regulation has to consider the local economic environment, the local financial system, the local culture. So things, you cannot just bring complicated regulations and implement it in a go that may not serve the purpose of developing. Because you have, on one hand, the regulation, but you also have all the ecosystem that is needed. For example, do you have monetary tools for liquidity management? This is not regulation. So you have to have the regulation, but you have to do it. You have to issue instruments, you have other things. Do you have regulation for the insurance sector, for the takaful sector? That's also complement this. So we have a lot of components, and no country actually came like in one day and they had everything all together. Sometimes if you have too much regulation, may not be as good as it is the intention to do it.
Please.
Why riba sensitivity is so low in the Islamic world?
Anyone to answer? His Excellency?
Okay. You mean sensitivity in terms of acceptability or or rejection?
It's getting low day by day in the Islamic world. You mean they are becoming permissive? They don't care about riba? What do you mean? Why riba sensitivity is getting low in the Islamic world?
Okay, I think. Yes, I think, well, if we, it's perhaps a difficult question. Maybe it needs some philosophic discussions about it. But what we can say, we did, with IRTI and with other Thomson Reuters, some country reports for many countries.
There is no much demand in the Islamic world for Islamic banks, for no riba financial activity.
No, okay. There is actually in most countries. Whenever we did it, even there was some studies, for example, in Europe. In Europe, talking about like Muslims that are living there. Sometimes they are not practicing, if we can say, Muslims. But if when there were surveys, and most of them, they say like over 50%, 54, 55%. They say if they have a choice to use Islamic finance, like no riba, they would do it. But most of them also, they say with one condition: it should not be more expensive than the conventional. So I think this is the point. In many countries, and we did it also in Morocco, for instance, and in Turkey also. For example, in Morocco, when we did a country report before the starting of the industry, the Islamic banking, like 2-3 years ago, the survey said there was maybe like majority again, maybe 80%, there were 80% saying that they would use it. But 80% of the like SMEs or entrepreneurs or companies, they said they will not use it if it is more expensive than the conventional. So this is, I think, it comes to kind of balance, competition. So they will be willing to use like halal way if it is not more expensive. So I think this is where the role of the others, regulators, and this ecosystem we are talking about, to have it to make Islamic banks perhaps more competitive.
I think Dr. Ishar has something to share as well.
There are many. My answer will be very straightforward. As I mentioned earlier, I indicated in my presentation, is that there are essentially 3 types of customers, and it has been based on the, using Brother Abdullah's word, survey, and this is real. First is loyal customer, right? As long as there is an Islamic prefix in any product, Bismillah, they will buy, irrespective whether the product is really Sharia compliant or not. As long as you call it Islamic, they will buy, for sure. And there is a type of customer like this everywhere. The second is what they call as the rational customer. Brother Abdullah mentioned that it depends on whether they have mobile banking, good services, international banking, and so on and so forth. The third one is swing or floating customer. They would wait and see, and so essentially there are these 3 types of these things. So yes, that will be my answer.
Please.
My question is, just after your conversation, my question is that why Islamic financial institutions cannot compete with conventional banks? We believe that halal things supposed to be the right things. So what is the problem in Islamic financing institutions? Is the operation is too expensive? Why they cannot compete, based on your experience?
Prasanna, can you?
This is, in my view, the answer which I have is something which I wanted to say in respect of the previous question, is that to put it differently, I don't understand very much about the Sharia aspects in detail, but I can tell you one thing. As a customer, if I go, what do I get from an Islamic bank which is different and from a conventional bank? That's the question. You have 2 things. In most countries, you have both, except for countries like Iran and Sudan. You have both available. So, in fact, the conventional banking has been there for a longer time and bigger. So, you have to wean them away. So, if I'm going to be a customer, what am I getting which is different from conventional bank offering? The answer is no, except for the fact that it is branded as Sharia compliant. So there are customers who simply go for that concept because they are looking for that faith. And apart from that, there is actually no difference. The difference need not be in higher returns. The difference has to be in originality, actually. Because I think there was the assistant governor of Bank Negara was talking to me last week, and he mentioned that after they introduced the investment account concept in Malaysia, 80% of the people who took to that concept were actually, not necessarily Muslims. Not non-Muslims. So basically what I'm trying to say, they were like, even non-Muslims were taking to it because the account or the product itself was distinctly different. There are people who want to take to that. So I think one of the better ways of Islamic finance, Islamic bank to grow would be to actually bring out products which are consistent with core Sharia principles, which is like risk sharing, risk pooling, and that way they will stand out completely different from conventional banks. And there are actually a lot of people looking for that. Actually, somebody like me, I don't invest in deposits, for example. So I would be very happily invest in a product like this because I have tolerance to that risk. So that's one way of gathering the. In banking as a business, all of us know it is a business where scale matters, size matters. And it is very clear that in most countries, Islamic banking has not been able to break out because they are still much smaller than they're not, and the conventional banks are much bigger, and that straight away, gives them a lot of, in terms of amount of money they can spend and resources, technological, whatever way. It's basically a size scale-based business, and if you have to get to there. And one of the ways is that to come up with innovative products which are true to their core beliefs, core things, which rational, which is Sharia, and then give them as an original alternative, which is different from what the conventional world is giving them. I don't think that's people are getting it.
So they can compete actually.
They can, yeah.
If they bring up better products, better alternatives, so they can actually compete with the conventional banks.
Yeah, that's what I'm saying. When I say better, I think more original. I want them to come out with something which is different completely, which is consistent with Sharia, which uses the core Sharia value, which is basically risk sharing, risk pooling, and fiduciary duty, which are the core values. These are values which are not core to conventional banking. And so in most of the Western world, banks have become, they have attracted hostility. People are actually so unhappy with banks. And why? Because they are not dealing in a honest manner, in a fair manner to clients. When everybody knows it, now people are making fun of the banks. So Islamic banks can actually go on the right against that and do a much better job and take up that spot. I'm sure people will be very happy to switch. Today, I think in many countries, including UAE where I live, the customers don't see any difference. They just accept the name. So I was having a Sharia compliant mortgage. I can tell you I have no difference between that and an ordinary mortgage. I couldn't see anything. It was just named as Sharia compliant mortgage, and the mortgage contract was 50 pages more than the normal contract, that's all.
Thank you. Prazana, any other question? Same question? So we already covered it. All right, thank you. So maybe I can talk about World Bank's AFSA program we conducted last year, Financial Sector Assessment Program, and we included, after doing it Pakistan, we included technical laws on Islamic finance as well. So we met with the governmental authorities and private sector players as well, and then we gave our recommendation to the Treasury, and Treasury allocate our recommendation to the related authorities, including the BRSA. And it is great to see that, I mean, one of our recommendations was the developing a comprehensive law for the Islamic finance industry. So seeing that progress is extremely important. So thank you very much for the team in BRSA as well. And this is the end of our session. Thank you, everybody. Thank you for our honorable guest, and thank you for your attention. Thank you.
Sayın konuklarımız, bugünkü oturumlar sona erdi. Akşam yemeğimiz olacak yine profesörler evinde. Hepiniz davetlisiniz. Yarınki oturumumuz saat 10'da başlayacak.